Good morning, students. This is CA Vibhavathavan. So we'll be starting the material costing today under paper 3 of cost and management accounting. So material costing is basically a very prime element of costing. It's one of the important elements of cost. All right. If you have attended the class of introduction, there as per the elements of cost, there are material, labor, direct expenses. So material is a major element of cost, and in every product, in every cost of the product, the material cost is very, very significant. So because of that, material costing becomes all the more important, because cost control under material costing has its own implications. So a slight decrease in the cost in material will lead to a much decrease in the total cost of the product, because material constitutes a big portion of any cost of a product. All right. So let's start material costing. So basically, what are materials? All commodities, physical objects used to make the final product. It may be direct or indirect. All right. So any commodity or any physical object which is required to make a product, all sorts of materials are basically the material, and it may be direct or it may be indirect. Direct materials are those cost of which can be directly attributable to the end product. End product means the final output for which it is being used. So it can be directly attributable, it can be directly identified, it can be exactly we know how much material is used in a particular product. That is the meaning of directly attributable or directly identifiable or directly allocated to the product. Right? Indirect materials are those which are not directly attributable. Of course, they are incurred for the product as a whole, but you cannot directly identify how much material is actually used in a particular product. So those are indirect material. And as I explained in the introduction class, indirect material or indirect labor or all those indirect expenses are part of overheads, because they cannot be directly allocated to a product. They are best can be apportioned. So that's again the difference between direct material and indirect material. Direct material are always allocated, and indirect materials are always apportioned on the basis of on some basis they are being shared by all the products or all the departments or between all cost objects. So material control, as I told you, material basically constitutes a very significant portion of the total cost of a product. So material control is as important as any other function of cost accounting. The function of ensuring that sufficient goods are retained in stock to meet all requirements without carrying unnecessarily large stocks. So the major challenge in material costing and in material control is that we should have sufficient stock always. Sufficient means there should be no shortage of stocks, and also there should not be overstocking, because if you are overstocking, of course, a huge capital is involved when you purchase the material. So capital investment is there, goods can be damaged, the materials which are in stores can get damaged, they get obsolete, they deteriorate with time. So it should not be overstocking, and it should not be that that there are not sufficient material in the stock and production can hamper. So that's why material control has its own role to play when we call about material costing. Objectives of material control: minimizing interruption in production process. So of course there should be sufficient stocks in inventory always, so that production should go on smoothly. Cost of material is a very, very important aspect to deal with, because from whom to purchase, from where to purchase, how much to purchase, and then when we have purchased, how to store them. So everything basically leads to the cost of material. Reduction in wastages, of course. So how we are handling the materials during production process, or when it is in inventory, how we are handling it, so that the wastages should be minimized. Adequate information should be there throughout, how many are receipts and how many materials are balanced and how much is the shortage of material, when we should purchase, how much we should purchase. So adequate information we should have always. Completion of order in time. So everything should be in time. Every completion of job or completion of order or completion of any product we have got it should complete it should be complete on time. Otherwise there should be, because everything is planned, everything is predetermined in its own way. So it should not have any deviation or variation to that extent. Elements of material control. So what exactly we do that, basically leads to material control only. So how we are going to do material control under the material costing? Basically, material control has its own phases. Like material control starts with material procurement. When material procurement means how we purchase the material from the vendor or from the supplier, from the outside market. So material procurement. Second phase is material storage. So when we have received the material, how we are going to store it. All right. So there should be proper handling of materials in inventory, in storage also, in stores also. And then the usage of material, how we are using the material in production. So basically material control has three phases: material procurement, material storage, and material usage. So if we can see here, purchasing of material, receiving of material, and inspection of material. We purchase the material, we receive the material at the factory, and then the inspection of material. So these three are basically for material procurement. All right. Procurement stage means when we purchase the material. Then storage of material, and then issuing of material. Issuing material for production. So then the store department issue the material for production. Maintenance of inventory records, of course. Nothing can happen without maintenance of records. So we maintain a whole lot of inventory records are maintained to basically have a smooth flow of materials, and there should not be no hindrance, at any stage of material handling. And of stock audit. There's always a stock audit which goes on. So this is basically the overview how everything works. So start with material procurement. So material procurement is basically, there are many documents, notes which are made, which actually, assist in material procurement. So first of all is bill of material. Bill of material is basically, if I explain you, it's a material specification list. So it's a material list, if you can say. So bill of material has the description and, specification of all materials which are used to produce any product. So, or for any job. So all types of materials which are required for a particular job or a product, all the description and detailed specification of all those materials will be in the bill of material. So every material which is required for a job, including the quantities of material required. So description and specification, that means the detailing of every material required along with the quantities, what all the materials are required. Every detail will be in the bill of material. So basically it's a standard document which helps the storekeeper also, which helps the production staff also, the production department also, that if you have to do this particular job, if you have to produce this particular product, then bill of material will have all the information that what all kind of materials will be required for this particular product and in what quantities. So bill of material is a comprehensive detail of every material which has to be used for a particular product or a job. Material requisition note. So material requisition note is basically made by the production department or any department which requires, or basically by the stores department also, that we want the material. So material requisition note is basically for the manufacturing process and everything. So it's a request note that we want this material. So production department will send the material requisition note that, okay, we want this material for production. So generally, any department which requires the material will send the material requisition note, that is MRN, to the stores department, because stores department handles most of the inventories. Purchase requisition note is basically issued most of the times by the stores department to the purchase department. So stores department will say, okay, we want all these materials. Who is going to purchase? The purchase department is going to purchase. So purchase requisition is basically the request note from the stores department that this material is getting out of stock. So please have a, next purchase for this material. We want the material in stock. Goods received note. So once the materials are purchased by the purchase department from the outside vendors or the suppliers, and the vendor delivers the goods to the factory gate, that's a good received note. So the receiving department will receive the materials after inspection, and then they will basically issue the goods received note to the supplier that, okay, we have received these materials. So GRN, goods received note, will be issued by the receiving department at the factory to the vendor or the supplier. Material return note. So in case, let us say, some material which the supplier has delivered is not up to the mark, it's not as per the specifications which we require. So then we return the goods which are not up to the mark or up to the standards or not as per the specifications mentioned. Then we return the goods along with material return note that, okay, these goods are not up to the mark. We are returning back to the supplier after inspection, of course, and then we issue a material return note. So these are all the basically the notes and the forms which are issued when we purchase the material or we issue the material for production. Then when the material is received at the factory gate by the receiving department, then we value the material received. So valuation of material received is also very important. The cost of the material is not only the purchase price, but it also includes every other charge which the buyer must have paid. So it's not only the purchase price. That's why valuation of material includes every other cost or expenses which the buyer must have paid. So after the valuation, yes, of course, we store the material. So material storage will be part of the inventory. So bin cards, stores ledgers, store control cards, basically they are the documents which are maintained, the records which are maintained by like bin cards are maintained by the storekeeper. So bin card is kept with every kind of material. So let us say material A is kept in a container. Along with the material, a card will also be displayed and kept inside the container that this material, this much is the receipt at this date. We have received this material and how much we have issued for production. So it gives the quantity details. All right. Then stores ledger we'll be doing in this session. Stores ledger basically gives the information in quantity and value both. Right. So bin card gives information just in quantity, how much material, let us say material A is how much is received at what date and how much is issued at what date and how much is the balance of quantity left. So bin card gives information only quantity wise. Stores ledger basically quantity and value both. All right, for how much we have purchased and for at what rate I'm issuing to the production. Then we have the valuation of material issues. So I told you material control, material procurement, then material storage, and then material usage. So material procurement is all types of notes we issue. Then material storage we do in the inventory by the stores keeper, stores department. And then we issue the material for production. So valuation of material issues. So there are different methods through which we issue the material from the stores to the production department or any other department which requires the material for manufacturing or for other things. So these are cost price methods, average price methods, market price methods, and notional price methods. So these are the methods which are used for valuation the material issues. And of course, the accounting and control of waste and spoilage and scrap and defectives, etc., which we are going to learn in this session. All right. Moving further. So valuation of material received. As I told you, the cost of material is not only the purchase price which we pay, but it includes all sorts of other expenses and costs and duties and taxes which we have must paid as a buyer. All right. So let me see if there are any queries. Okay, so see, we have to use the English medium only. So some of the words, if you would like to know that, I can explain you in Hindi, but otherwise the session has to be in English, all right? So valuation of material receipts. After the procurement of material from the supplier, actual material cost is calculated. Actual material cost, right? So it's not only the purchase price. The statement of cost of material purchased is called valuation of material. So basically, whatever the material is purchased, the cost of it is basically we have to include the valuation of material. So cost of material includes the cost of purchase, net of trade discounts or rebates or duty drawback or input credit and other costs incurred in bringing the inventories to their present location and condition. So let us see what all costs are included and what are the treatment of other items which are associated with purchase of material, whether they should be deducted or which should not. Trade discount is always deducted from the purchase price. So it should be shown as a deduction inside the invoice only. All right. So trade discount is deducted. It has to be, if it is not shown as a deduction in the invoice, so it has to be deducted. So trade discount deducted. Quantity discount. Sometimes we order bulk. In bulk means in large quantities we buy. So the supplier or the vendor gives us quantity discount also. All right. So quantity discount, of course, any type of discount, when it's the trade or quantity, is deducted from the purchase price. So it should be deducted from in the invoice only, but if it's not, then it has to be deducted. Cash discount is not deducted from the purchase price. All right. Cash discount is it should be excluding the purchase price. All right. So if you remember in accounts, we pass the entry. All right. Purchases account debit to cash or bank or whatever, and to discount received on purchases. Right. So that means, but discount received is not deducted from purchase or it's not added from purchase. So cash discount is not deducted from the purchase price. It is considered as a financial charge or as finance expenses. Clear? So cash discount, you keep it away from the purchase price. It's not deducted. Subsidy or grant or incentive. So any subsidy, grant or incentive received from the government or from other sources deducted from the cost of purchase. All right. So this will be deducted. So all those four things. Road or toll tax, of course, if it is paid by the buyer, it has to be included with the cost of purchase. So road tax or toll tax, if it is not included, you please add it to the cost of purchase. IGST integrated. So if you have certain idea about GST, when you have interstate sale or purchase, interstate means between one state and the other state. Let us say between UP and Haryana. So interstate purchase or sale, the government charges integrated GST. So of course we pay it. All right. So integrated GST is paid on interstate supply of goods and provision of services and collected from the buyer. So GST is paid by the buyer. It is collected from the seller by the seller, and the seller deposits the GST to the government. So GST is collected from the buyer and from the buyer by the seller and deposited to the government by the seller. Clear? So it is excluded from the cost of purchase if credit for the same is available. So what happens is GST, whatever we pay on purchases, we get the refund of that GST in a form of credit, in a form of set off, if you understand that way. So the GST paid on purchases is set off when we actually sell the finished goods. So when we are selling the finished goods, we become a seller, and during sale, we must have received the GST from the buyer. Clear? So when we pay GST as a buyer and when we collect GST as a seller, so the input GST which we have paid on purchases is set off against the GST we have collected from the sale. Clear? So that we call as credit. Credit means any input GST or any GST paid on purchases is set off when we sell the goods and collect the GST from the buyer, right? So if we are paying GST on purchases and we are getting it back in the form of set off or credit, then of course it is not part of cost. Clear? Because we are getting it back in some or the other way. So when we are getting it back later on, it's not a cost to us, right? So it is excluded from the cost of purchase if credit for the same is available. Credit means it will be set off later on. All right. Unless mentioned specifically, it should not form part of cost of purchase, because generally we get a credit on input, the GST paid on purchases. Similarly, state goods and service tax and central goods and service tax. So SGST and CGST is paid on manufacture and supply of goods and services when it is intra-state. Intra means within the same state, within UP. All right. So it is excluded again from the cost of purchase. So within the state, if there is a sale and purchase, so we pay SGST and CGST. Both the components we pay for intra-state sale and purchase of goods and services. So again, this also, if we have paid on purchases, we get it back as credit, as set off. So when we are getting it back later on, we should not include it in the part of purchase. It's not cost of purchase for us then, because we are getting it back later. Basic custom duty, of course, if we are paying on import of goods from outside India, it is added with the purchase cost. So basic custom duty is added because we pay. It's on import of goods from outside India, right? Demorage. So demorage is basically a penalty imposed by the transporter for delay in uploading or offloading of materials. So let us say the transporter has got the goods from the supplier, and the truck is lying at the factory gate, and it's being delayed from our side because a lot of time is taking in offloading and uploading or whatever. So the transporter basically charges a penalty, that is a demurrage charge. So it's an abnormal cost and not included in the cost of purchase. So any form of penalties or abnormal cost or abnormal expenses will not be added to the cost of purchase. Similarly, detention charges, fine is imposed for non-compliance of rule or law or by any statutory authority. Again, it's an abnormal cost. So any abnormal cost in the form of penalties or fines or demurrage will not be added. Penalty again is not included in cost of purchase. Other expenditures, insurance, which are paid for protection of goods during transit. Of course, insurance charges are added to the cost of purchase. Commission of brokerage, if you have paid means the buyer has paid, it will be added. Freight inwards, it's added with the cost of purchase always because it's directly attributable to the procurement of material. So freight inward, carriage inward, cartage inward, any such form of expense will be added to the cost of purchase. Cost of containers. So sometimes goods are in liquid form, for example, and they come in containers. They cannot come loose. So the supplier sends them in containers. So if they are non-returnable containers, that means the supplier must have charged from you the cost of containers also. So if you have paid for the containers, then it will be added. Returnable containers, that means you will return the containers back to the supplier. So if you are returning the containers back to the supplier and you get a refund of the container cost, then it will not be added. So something which you are paying and it will not come back or refunded, then you will be adding. Something which you are paying but it's non-refundable, then it will be added. Something which you are paying and it will be refunded back to you, then of course it will not be added because it's not a cost of purchase for you. It will always be refunded. All right. So non-returnable will be added. Returnable will not be added. So let us say if the full amount is not refunded, so whatever is the difference will be added. All right. Shortage. So the shortage due to normal reason and abnormal reason. So there are shortages when we handle the material. A lot of shortages basically occur. So some shortages has to happen because it's the basic instinct nature of material that it has to happen. But abnormal shortages, that means due to mishandling, the material got damaged. So that's why there was a shortage. So of course, abnormal reasons, they will have different treatment. Okay, so there is an illustration I've included in between. Let me see if there is any query. Yes, of course, we have to add the custom duty along with the cost of purchase. If ITC has taken on material. Okay, yes. If input tax credit has taken, then GST, yes. When you get the input tax credit, then GST will not be added because GST is not a cost to you then, because you will get a credit later on. So that means you're getting it back, right? Yes, quantity discount is given by the supplier after achieving a level of specified quantity. Yes, of course, quantity is purchased over a period of time. Then at what point of time it has to be deducted from the quantity discount is given. If it is given at the time of purchase, then only it will be deducted from the invoice. All right. Credit of GST. Then what will be the adjustment? See, credit of GST, we will not be discussing GST as such here. But yes, only the concept is if we are getting the credit of GST, we will not be adding it in the cost of purchase because GST will get back to you. You will get it back in the form of a credit or a set off. All right. Yes, GST will be excluded. Demorage is basically when when you are taking a lot of time in offloading the goods from the truck to your factory gate and the transporter is waiting outside the gate, so transporter charges a fine in the form of demurrage. All right, so that again it's a fine, it will not be added to the cost of purchase. Insurance charges will be added. Insurance charges will be added for protection. All right. So let us move to this question. So this is an invoice. This is a chemical A, 1 lakh, chemical B, 1,04,000. Basic custom duty, credit is not allowed. Railway freight and the total cost. All right. So a shortage. So basically it's a question of the shortage. So a shortage of 500 kgs is chemical A because see the basic nature is of the material is chemical. So chemical tends to evaporate. Chemical tends to dry up also, evaporate also. So normal shortage has to happen. Any type of material, let us say if it's let us say coal or it's a salt. So whenever I'm uploading or offloading the salt, salt rocks of salt. I mean, the salt has to, all those, dust of salt has to be there everywhere. So the normal shortage has to happen. The normal wastage has to happen. But we should avoid the abnormal one. All right. So a shortage of 500 in chemical A and 320 in chemical B is noticed due to normal breakage. All right. So sometimes normal shortage or normal waste has to happen and we have to take into account while calculating the cost of the product. So you are required to determine the rate per kg of each chemical, assuming a provision of 2% for further deterioration. So basically, we have the total cost. We have to calculate rate per kg of chemical. So how will we calculate rate per kg? Total cost divided by total kgs. Yeah. So first we have to calculate how much are the effective kgs after, taking care of normal wastage or normal shortage. So this is the next slide is basically, first of all, how much is the effective quantity we are left with. See, we purchased 10,000 kgs of chemical A and 8,000 kgs of chemical B. So shortage due to normal breakage is 500 kgs of A and 320 kgs of B. Clear? And further deterioration, 2%. So further deterioration means 2% should be calculated on 9,500 and not 10,000 because 500 has to happen. And then there is a provision for further deterioration. So they are estimating a further 2% the material can be wastage or there could be further shortage. So 2% further means 2% should be on 9,500, right? So 190 and 153 are there further 2% deterioration. So effective quantity we are left with is 9,310 kgs of A and 7,526 kgs of B. So this is the effective quantity we are left with. Now let's see the cost. So if you can see the cost here, purchase price 10,000 at the 10 per kg and 8,000 at the rate of 13 per kg. So I told you that the cost of material, the value of material is not only the purchase price, but every other thing which has been added. So if you can see the question, I'll take you back to the question. See, it was the 10,000 kgs at the rate of 10 per kg. So 10 and 13 were the basic purchase price. Basic custom duty is 10%. Railway freight 3,840. So railway freight, basically we will apportion between chemical A and chemical B on the basis of the quantity purchased. Quantity purchased and not the effective quantity. So railway freight 3,840 will be apportioned between A and B on the basis of 10,000 and 8,000 respectively. All right. So next moving. So basic custom duty 10% we must have paid. Railway freight in the ratio of quantity purchased, 10,000 and 8,000. All right. So 2133 and 1707 are we have added the railway freight. So total cost comes out to be this. Effective quantity, which we have calculated in the back slide. So the effective quantity and the rate per kg. So this is how you have to basically calculate the value of the material, taking care of every other cost or duty or tax which must be included in the question. All right. So this is the way we calculate it. Just go through once. So this was the question. A shortage, we have taken care of the shortage, and of course a further deterioration in the chemical. So this was the quantity available. We have calculated the effective quantity after taking care of shortages and further deterioration. So effectively, we are left with 9310 and 7526 of both the chemicals respectively. And then we have calculated the total cost by adding the custom duty and railway freight. So total quantity is there and total cost is there. So rate per kg is total cost divided by the effective quantity. So rate per kg has come this way, the value of material per kg. Clear? Let's move on to inventory control. Let me see if there are any queries. See, if quantity discount is basically received at the time of purchase only, at the time of invoice only. Because if you have already purchased the bulk quantity, it is received at the time of purchase only. Yes, rate per kg should be this. Very good. So somebody has calculated the rate per kg. Josh has calculated the rate per kg. I hope this is what we have. Yes. Yes, you have calculated exactly. Major insurance during transit will be added instead of whole insurances. Why they? No. Insurance during transit means we basically get the materials insured for the damages during transit for most of the time when the supplier is sending the material, because insurance in our inventory, in our store, it is different, but the supplier always charges the insurance because it is basically to protect the goods during transit. All right. So moving on to inventory control. So the main object of inventory control is to achieve maximum efficiency in production and sales with the minimum investment in inventory. Inventory comprises of stock of raw materials, stores and consumables, work in progress and finished products. So techniques of inventory control, how we can basically achieve inventory control with maximum efficiency. So basically inventory control, the main purpose is we should have minimum investment in inventory, minimum capital should be blocked, minimum. All right. Only that much inventory as is required, and inventory comprises of all these stocks. So every inventory we have to control, through these techniques and mechanisms. So basically we do it by setting up various stock levels. Then we determine the economic order quantity. Then there's a 2-bin system, establishment of system of budgets. We use perpetual inventory records. Perpetual means every, it's a continuous process. The storekeeper maintains the inventory with every receipt and every issue. So it's a continuous stock taking, all right, by the storekeeper. ABC analysis, review of slow and non-moving items, and use of control ratio. So these are the techniques basically we use for inventory control. Some of them, of course, we have included in detail here. So starting with various stock levels. So levels of inventory, the reorder level, the minimum level, the maximum level, the danger level, and the average stock level. So these are the setting of various stock levels which help us in maintaining the stock levels optimally. That means there should not be overstocking and there should not be insufficient stocks also that will hamper the production. So the production flow should continue always. So these stock levels help us to a great extent to achieving the efficiency in the stock flow and stock maintenance. So first of all is reorder level. It is the point at which the stock of a particular material approaches. The storekeeper should initiate the purchase requisition of fresh supplies of that material. So reorder level is the level at which, if the stock basically reaches to that level, let us say whenever the stock will reach 200 kgs of that particular material, now it's the time to basically place a purchase order. That means now it's the time to purchase the material because the stock of the material has reached, let us say, for example, 200 kg. So reorder level is the point at which you have to go for next purchase. So the storekeeper will send a purchase requisition to the purchase department that now it's the time for the next purchase of this material, because we have reached to the level of stock where we should place a purchase order. Because, when you issue a purchase requisition to the purchase department, it takes time to get the material. It's not that it's just a call away that, okay, we want the material and material be with you. So material delivery takes time. It's the whole process that we have to follow. So we have to give time to the purchase department also to, procure the materials. So for that time, we should have enough stock of material with us for production, right? So that is the significance of reorder level and how it is calculated. Maximum consumption into maximum reorder period or maximum delivery period or delivery time. So this is how we calculate reorder level. Then minimum level, it represents the minimum quantity of material which must be maintained always. All right. The quantity is fixed so that production may not be held up due to the shortage of material. So this minimum level of stock we should maintain at all times. We should not go below the minimum level. So before the minimum level only we should have the next purchase, or we should have the sufficient stock with us. We should not go beyond, below the minimum level. So minimum level of stock is reorder level minus normal consumption into normal delivery time. So this is how we calculate the minimum level of stock. Maximum level is beyond that. You should not hold the stocks because, that will be overstocking. So the maximum level is that this is the maximum level of stock you should maintain in your inventory. You should not purchase more than that because, it can go obsolete, it can deteriorate, it can damage. Why to overstock? We should, stock the inventory only as much as is required by the levels of stock. So maximum level says beyond this, we should not keep the stock in inventory. All right. So reorder level plus reorder quantity minus minimum consumption into minimum delivery time. All right. Or minimum basically reorder time. So this is the maximum level. Danger level means at which the normal issue of material are stopped and are made only under specific instructions. So basically danger level is that, let us say there is a scarcity of the raw material which we use in the market. That raw material is not available, or maybe that supplier has not got enough supplies for us. So now we have reached to the danger level. So when we reach to the danger level, the normal production stops and only the material which are issued for emergency orders, only for those orders the material will be issued. The normal production stops when the level reaches to the danger level. And of course, we should never reach a danger level. That's why the levels of stock which guide us that when to place the next order so that this situation should not arise. All right. And how to calculate this? Average consumption into maximum delivery time for emergency purchases. So let us say the normal delivery time for normal purchases is 15 days. For emergency, it could be 9 days or 8 days. So emergency delivery time should be less than the normal delivery time. But again, it also does have a delivery time. Yeah. So average consumption into maximum reorder period for emergency purchases. So quickly have a look again. Reorder level, maximum consumption into maximum delivery time, minimum reorder level minus normal consumption into normal delivery time. Maximum level is reorder level plus reorder quantity minus minimum consumption into minimum delivery time. Danger level, average consumption into maximum reorder time or delivery time for emergency purchases. Yeah. And then the average minimum stock level plus half of EOQ, or minimum stock level plus maximum stock level divided by 2. So a better way to do is minimum stock level plus half of EOQ. So there's one illustration also. If you can quickly calculate all the levels of stock. So I'll give you 2 minutes for this. So quickly do it and calculate all the levels of stock. You should calculate the normal, the maximum, the minimum. First of all, you should calculate the reorder level. It should always be in sequence. You should calculate reorder level first. All right. So 50 per week is the normal usage. That means average. Maximum, this concept 75 per week is the maximum consumption. Usage is the consumption. Minimum consumption is 25 per week. Reorder quantity for A is 300, for B is 500. So you have to calculate for both the materials. Reorder period, that is a delivery time. A 4 to 6 weeks, B 2 to 4 weeks. So calculate for each component. For A also, for B also. First calculate reorder level. Let me see who has calculated reorder level for A and B both. Dhyanesh, EOQ is economic order quantity. We'll be just doing in a while. Please tell me the reorder level. Reorder level for A and B. Okay, once Utkarsh has calculated, it's 450. Utkarsh, 450 is for what? Utkarsh, 450 is for A or B? Quickly calculate reorder level. And then the minimum, maximum, and the average. Okay, Nikita has calculated for A 450, for B 300. Okay. For A it's 450 and for B it's 300. After reorder, calculate minimum, maximum, and average. See, reorder period 4 to 6 weeks. That means 4 is the minimum delivery time. 6 is the maximum delivery time, and average has to be 5. All right. So this way you have to analyze. 4 minimum, 6 weeks are maximum. So 5 has to be average or normal. Similarly for B, 2 to 4 weeks. 2 has to be for 2 minimum, 4 maximum, and 3 has to be for. All right. So a lot of students have calculated. Let me now show you. So this is basically all the 4 levels. Reorder level. Maximum usage into maximum delivery time. Minimum reorder level minus average usage into average delivery time. So I told you average for A has to be 5. Why? Because 4 was minimum and 6 was maximum. So 5 has to be average. Then maximum level, reorder level plus reorder quantity. Reorder quantity is already given in the question. Reorder quantity is already given in the question. So if you can see, I can quickly show you the question again. See the reorder quantity. For A it was 300, for B it was 500. Reorder quantity is nothing but economic order quantity. So in this question, it's already mentioned. Clear? So reorder level, I think most of you have calculated. Minimum level, maximum, and average. Calculate please, and then the answers are also here. So minimum is reorder level minus average consumption into average delivery time. Maximum level is reorder level plus reorder quantity minus minimum consumption into minimum delivery time. Average, minimum plus maximum divided by 2. So here it is calculated this way. Utkarsh, I just explained you the normal delivery time. If minimum is 4 and maximum is 6, average has to be 5. So Utkarsh, I hope you have understood this. Delivery time, Utkarsh, you still have a doubt in the average delivery time? If I can quickly show you the question again. Reorder period 4 to 6 weeks. So 4 has to be minimum, 6 is maximum, 5 has to be average. Here, so 5 you can calculate on your own also. 2 to 4 weeks. So if 2 is minimum and 4 is maximum, then of course 3 comes to be average. So this way you have to calculate. So most of the time question comes this way also. You should know the difference between minimum and maximum will be. All right, Utkarsh, good, that no doubt now. So all the 4 levels of stock, have you calculated, all of you? All right. So shall we move on? Have you calculated all levels of stock? Okay, now comes to economic order quantity. Economic order quantity is a reorder quantity. See, the levels of stock, the reorder, maximum, minimum, average, the reorder levels or the levels of stock tell you when to purchase. All right, the reorder level tells you when to purchase the next order, when to place the next order. The levels of stock tell you how much to maintain in the inventory. How much is the maximum level which you should maintain? You should not overstock. Minimum level tells you how much minimum you should maintain at all times so that they should not be overstocking. So the levels of stock tell you how much, when to purchase and how much levels of stock to maintain. Economic order quantity or reorder quantity tells you how much to purchase. So if I suppose I have to place a new purchase order, a fresh order for purchase, I should know how much to purchase, how much quantity should I purchase in that one order. So if I have to place a new order for purchase, how much quantity should I need? Should I purchase 500? Should I purchase 1000? Again, because it should not be overstocking. So economic order quantity tells me how much to purchase in one purchase order. All right. So basically, because why is it so important? Because again, there's a lot of cost which are associated with the purchase. I'm purchasing it, so purchase cost is associated with it. Then when I am receiving it, the storage cost is associated with. When I receive the material at the factory, I have to handle all those materials. There should be enough space with us to handle the materials and hold the stock in inventory. And there can be obsolescence. The materials can get damaged. So whole lot of cost is associated with material handling also in inventories, right? So there has to be a very careful decision that how much stock, how much quantity we should order when we always go for reorder level. So reorder tells me that, okay, now is the time to purchase, but how much to purchase? So that is the significance of economic order quantity. Economic order quantity means this quantity will be economical and optimum for us. The cost will be minimum. All right. So economic order quantity includes ordering cost. Ordering cost means the cost of requisitioning, order placing, transportation, receiving, inspecting, and storing, administration. So ordering cost. Carrying cost means handling of material, warehousing, handling, clerical staff, insurance, depreciation, obsolescence. So these are the carrying costs. So all these are costs are associated when we purchase the material. We purchase and then we store. So before it goes to for production, we have to handle it in inventory. And ordering and carrying cost trade-off. So let us understand in detail. So ordering cost are all these, the cost and the carrying cost. So these are the basically, what are all the ordering costs will be the breakup of ordering cost and on the carrying cost. Carrying cost means the storage cost, all right, the handling cost. So carrying cost could be, there are different words used for carrying cost. Carrying cost means the storage cost of material which we have ordered. So now we have to handle the material in stores, right? So all these costs will be incurred when we have to store the materials in inventories. So carrying cost or storage cost or handling cost, any nomenclature we can use here. So this is the way we calculate economic order quantity under root 2AO. So 2 is a fixed multiple. A is the annual usage of raw material, not finished product. We are doing raw material purchase. Clear? So this will tell us how much raw material which we have to purchase. So A is annual consumption of raw material in units. Remember, it's economic order quantity. The answer should be in units of raw material. And raw material unit could be kg, could be liter, could be ton, could be anything. All right. So the answer should be in quantity because you are calculating the quantity and not the value. Clear? So annual consumption, usage means consumption. Annual consumption of raw material. O is the ordering cost. P is the cost per unit of purchasing cost. C is the carrying cost as a percentage of average inventory. Average inventory means carrying cost can be given as a percentage of P. P is the average inventory. Average inventory means purchase cost per unit. All right. So it will be used when we'll do the question. So 2 is a fixed multiple. A is annual consumption of raw material. O is the ordering cost. So 2 into A into O divided by C. C is a carrying cost. It can be given in absolute amount or it can be given as a percentage of average inventory. Average inventory means the purchase price per unit. All right. So, okay. So this is one illustration. You can quickly find the EOQ. So EOQ, if we can find. Okay. Calculate EOQ. How basically we calculate EOQ? 2 fixed multiple, 10,000. 10,000 is annual consumption. Ordering cost is 50, right? Divided by storage cost. So storage cost, carrying cost, handling cost is one and the same thing. 8% on average inventory. Average inventory is cost per kg of material. Purchase price per unit of material. Per unit here is per kg. So 2. So 8% on 2 rupees. So 8% of 2 you can calculate. 2 into 8%. 0.16. Clear? So first calculate the numerator, then divided by the denominator, and then final step would be the under root. All right. So 2 into 10,000 into 50 divided by 8% on average inventory, that is 2. So it will come out to 2,500 kgs. I hope you are able to do it. If a company makes sure of, then they should not calculate levels and annual requirements as already calculated by EOQ. Yes. So EOQ, Nikita, Divyansh, okay. 2,500, of course, has to be the, yes. So most of you have done it. 2,500, are you doing it? So this is the way we calculate EOQ. So shall we move forward? This is the way we calculate EOQ. Yes. So many of the students have managed to calculate. Good. Always remember the answer should be in kgs. All right. It should be in kgs. That is important to understand. All right, let's move further. So this was economic quantity. That means that in one lot, in one purchase order, we should not order more than 2,500 kgs. All right. So economic order quantity is in one lot, 2,500 kgs we can order. All right. So which will be economical for us. All right. Moving forward to valuation of material issues. So there are different methods of material issues: cost price method, average price method, market price method, and notional price methods. All right. So we'll be doing here cost price method. Of course, cost price means that the purchase price or the valuation of material which we have done. So cost price method, that means we are issuing the materials now. I told you beginning that the material control involves 3 phases. Material procurement. So we have done material procurement. And then there's material storage, where all sorts of records are kept, like bin cards or store control cards or stores ledger. And then there is the issue of material. Issue means the usage of material, the consumption of material. All right. So here we'll be using that. Cost price methods will take care of the issue of material at cost. Clear? Cost means whatever cost we are purchasing the material. Again, not the purchase price, but the whole lot of value which we have done. Clear? Average price, basically average price, we have two methods. In average price, we have simple average and we have weighted average. So average price methods dilutes the individual lot of stock. All right. So the stock which has come in individual lots, we just ignore that. And all the lots, we collectively take the price as we collectively consider the price of all the materials in the stock of all the lots. So lot wise purchase and lot wise issue is not there in average price. As against this, in cost price, yes, we have, for different lots have different rates of purchase, and we consider the issue accordingly. So the lot which we purchase from and the lot which we will issue will carry the same rate. Here. Then market price methods and the notional price method. So we'll be doing in detail the cost price and the average price methods. Market price methods basically are the two methods here. I can explain here only. So one is the replacement price. And then is the realizable value. So market price methods mainly are the two. Replacement price methods are basically that, let us say I have to issue the material. Now, at what price I have purchased that material, that is not relevant. So if I have purchased material A for rupees 50 per kg, I will not issue the material to production at 50. I will find out because, there is a time gap between when I would have purchased material A and today if I am issuing the material for production. So let us say I've purchased the material A in January and I'm issuing the material A in March. So there is a time lapse of 2 months. If I'm taking the cost, the price of January, will it be feasible that I'm issuing the material in March and I'm taking the purchase price that was in January 2 months back? So replacement price is basically vis-a-vis the market price. What is the current market price going on? So replacement price method is if today I go to the market and buy a similar product or a similar material, what price it would be. So if I want to replace this material today, what the identical material or a similar material will fetch in the market. All right. That price I will take for issue of material for production. So issue will be at the current market price. All right. Realizable value is whatever material I'm issuing for production. If today I sell that particular material in the market, how much value it will carry. All right. So there are basically two market price methods which are most prominent. Replacement price is what price a similar material will, if today if I go to the market, what price a similar material will fetch in the market, that at that price I will issue the material. Realizable value is this particular material, if today I go to the market and sell, how much price it would fetch. That is the price the material should be issued at. All right. Notional price methods are basically the price which are not the actual price. Notional price are the standard price. That means it is already predetermined that this price the material will be issued at. Notional price has nothing to do with the purchase price, the material which I have purchased for, or the current market price which is going on. Notional price, that means the material will be issued to the production at a predetermined rate. Not the current market price, not the purchase price of the material, but a predetermined rate. And of course, the predetermined rate is also calculated keeping in view the current market price, the future market prospects, the logistics cost, the transportation cost. So it's not that a predetermined rate or a notional price is just randomly it is kept. It is also kept after much deliberations. It is also kept after taking care of the current price and the future price or the future market trends, all the logistics cost, all the transportation cost, and every other cost that is associated. So notional prices, it has nothing to do with the actual purchase price or the actual market price. It is a predetermined rate, and every issue will be issued at the notional price or predetermined rate. So of course, the most prominent and popular ones, the most commonly used are cost price methods and average price methods. All right. So we'll be starting with the cost price methods first. All right. Before that, let me see if any queries you have. Okay, Jyoti has a doubt here. Okay, Jash also did. Jash, you still have not understood. Okay, let us. A couple of students have the queries in this EOQ. It's not 16, Jyoti. It's 0.16. 0.16 means 2 into 8%. So 8% on average inventory. Here, Jyoti. So 8% on rupees 2 cost per kg. Average inventory means per unit of the raw material. So it comes out to 0.16, not 16. All right. So it will be 0.16. So if I calculate 2 into 10,000, I've just moved backwards to EOQ because a couple of students. Okay, Josh, have you understood now? Okay. 50 divided by 0.16. So the answer comes out to 62,50,000, and then we calculate the under root. The answer will come to 2,500 kgs. So I hope now all of you have understood. All right. Okay. We are moving forward now. So these are the valuation. Okay, good. So these are the valuation of materials I was just discussing. So I discussed the market price methods and the notional price methods, and we'll be doing in detail the cost price methods and the average price methods, which are most commonly used. So cost price method, first, the most common method is FIFO, first in, first out. All right. This method uses the most recent price paid for the goods as a basis for valuation. Valuation means for the closing stock. See, what is the significance of material issues? See, we have purchased the material. All right. That was the first segment. Then we have stored the material. Why we are purchasing the materials? Why? What we have to do with the material? We have to issue the material for production or for issue the material to any other department which requires the material. Clear? So we are issuing the material now. Now we have purchased the material and then we have issued the material. So the balance is the stock which is left at the end of the year. All right, or end of the period, whatever period it can be. See, that's the difference between financial account and cost accounts also. Financial accounts, the records actually are prepared on an annual basis. We want the profit or the loss or the asset or the liability for the whole year. And then what is the balance of the profit? So we calculate profit for the whole year. As against this, cost accounting does not actually work on an annual basis. So if I want the information for 1 month, my period is for 1 month. Then if the information I need can be for 2 months or per week or per day or per fortnight or per annum or per 6 and monthly or semi-annually. So in cost accounting, there is no fixed, term for which the cost accounting records are made. All right. So that is the best part of cost accounting. So here also, if I want to know, let us say, what is the stock left after every month? That also we can calculate. So after every month, let us say I'm making the store record for the month of January or for the month of December. So every monthly stock. So how much stock is left at the month at the end of January? That is 31st January. How much I'm left with? So whatever stock I'm left with, maybe after a month or after a week or after a year, that means the closing stock. So basically, the first and foremost reason to maintain the store records for issues is how much is the value will be attaching to the closing stock. This closing stock actually goes to your trading account and the balance sheet asset side, if you know about financial accounts also. All right. So here it is valued and there it is posted. So in cost accounting, actually, it is the cost accounting which values the closing stock as per the different methods we'll be understanding today. Clear? So whatever we are left with, now at what price we should value the closing stock? So first in, first out tells you that the oldest stock, the oldest purchase we will issue first to the production. So that means the latest stock will be left for closing stock and it will be valued at the latest price. Clear? So we'll be understanding once we'll do the question also. So this method uses the most recent price paid for the goods. Recent means the latest purchase as a basis for valuation of closing stock. So stock will be valued at the latest purchase price because the oldest purchases will be issued for production and the latest, the last purchase will be left for the closing stock. The basis philosophy behind this approach of inventory valuation is that the first units purchased, that means the oldest units, are considered the first units to be issued or consumed for production. Clear? So the oldest purchase will be issued first and the latest purchase will be kept as closing stock if it is left. Clear? Thus, according to FIFO, as it is frequently called, the physical flow of the units follow chronological order. Chronological order means the oldest will be issued first and more so. All right. So let us say the purchase of 1st January will be issued first to the production, then the 3rd January, then the 4th January, then the 5th January. So let us say there is no production after 25th January. So whatever is the latest purchase will be there in the closing stock. All right. This method is most appropriate for perishable. Perishable means which gets destroyed or damaged or, obsolete fast, like milk, vegetables, and fruits. So the milk which you have purchased yesterday, it's very logical. Whatever milk and vegetable you have purchased yesterday, you will use it first rather than those which you have purchased today. So one milk packet you have purchased yesterday and one milk packet you have purchased today. Which one you are going to use it first? Of course, the yesterday one. That exactly is FIFO. So the yesterday one milk, that means that you have purchased first, will be issued first. And the latest purchase, that is the milk packet you have purchased today, let us say you have not used it. So this will be left with you as a stock. And today purchase price, that means today's purchase price is the latest purchase price. So stock is valued at the latest purchase price and issues are made at the oldest prices. All right. So that is the whole idea about the FIFO. Let me just see if you have any doubt regarding it. All right. So we have this. Okay, there are different methods in not only two, yes, FIFO, and there are other methods also in cost price methods, and then there are average methods also. All right. So let us move. Last in, first out. Last in, first out means this inventory valuation method is based on the assumption that the last item purchased, last in, first out, last means latest. So the milk packet which I have purchased today will be issued first. And the milk packet which we have purchased yesterday will be part of the stock if it is not used. So it's total contrast between FIFO and LIFO. In FIFO, the yesterday purchase will be issued first. In LIFO, today's purchase, that means the latest purchase will be issued first. So in FIFO, the latest purchase will be part of closing stock. In LIFO, the oldest stock will be part of closing stock. That is totally in contrast with both the methods. So this inventory valuation method is based on the assumption that the last item purchased is the first item used or sold. Last item means the latest. Clear? So the last item purchased is the first item used or sold. Thus, under this method, the units of the earliest purchases form the ending inventory. Earliest means the oldest. Clear? So like I explained, the milk packet which I purchased yesterday will form the ending inventory or the closing inventory, which results in matching the cost of current purchases against current sales. So what is the idea behind it? The packet which I purchased today must be at the latest market price, and that I'm issuing to the production. So the current market price will have the cost of production. See, issue means I'm using it for production. So whatever material I'm issuing to the production will actually be part of the cost of production. So that means cost of production will be at the latest market price. All right. So cost of production will be latest. And when I'm selling it will always be at the latest market price. So the whole idea is the purchase and the sales both will be at the current market price, and the closing stock will be at the oldest market price. Clear? So here again, the method, the units of earliest purchases form the ending inventory, which results in matching the cost of current purchases against current sales in the profit and loss account. So I hope you got the idea here. In FIFO, what happens is the cost of production. See, whatever the material I'm issuing to the production, they form part of the cost of production. So in FIFO, the cost of production will be at earlier market prices, and the sales is at latest market price. But in LIFO, the cost and sales both are at current market price because I'm issuing the material of the latest purchase. So that is a complete contrast under both the methods. Yeah. LIFO method is appropriate during the inflationary condition. Inflationary means when the prices are rising continuously. So when there is a rising trend of the prices. Clear? So pricings are rising consistently as it shows inventory at lower value in the balance sheet. So the closing stock, if you remember in financial accounts, closing stock comes in the balance sheet. So the closing stock will be at the lowest prices because in LIFO, the closing stock is basically on the basis of the earliest purchases, and the issues are from the latest purchase. So closing stock will be left out of the earliest, the oldest purchases. So closing stock will be valued at the lowest value because prices are rising every day, right? So closing stock will be at the lowest value, and there is a reduction of income and the profits and consequently income tax. Why? Because the cost of production will be at the highest prices. Clear? So cost of production is at highest price when cost is high because I'm issuing the material which are part of latest purchases. So the cost is high, of course, the profits are going to come less, and the profits will be lower. So if the profits are lower, the income tax also becomes low. So this is the basically significance of LIFO. The special feature of this method is that basis of valuation remains unchanged despite of price changes. It also tends to stabilize income by minimizing the effects on profits of inventory price changes. So basically there are different price changes of inventories, but we are taking the latest one. So my income will be stabilized because I'm taking the cost as per the latest price only. Yeah. So this is the significance of LIFO. So I have explained you in detail the FIFO and the LIFO. Let us move to the average price methods quickly. Average price methods does not take into account lot-wise purchase. So all the purchases till one particular day. So let us say I have 10 purchases before today. Today I have started the issue for production, and before today, whatever purchased I have done so far, all will be accumulated and a single price will be calculated. So basically the lot-wise purchase and from which lot the material is coming hardly has any significance in average price. Average price means that all the lots are diluted, all the prices are diluted, everything will be accumulated and then a price will be calculated. So average price method, materials are issued at valued at average price, which is calculated by dividing the total of all units rate by the number of unit rates. So all the units together, all the total of the units by the number, whatever lot number I'm taking. Let us say I'm taking 10 lots. And so I will add up the rates of all the 10 lots of material I've purchased and then divided by the number of lots I have taken. So simple average. When the materials are received in uniform lots of similar quantity, otherwise it will give wrong results. So of course, suitability of simple averages when the materials received in uniform quantity. So every time I'm receiving the material in 100 units, 100 units in one lot, then 100 units in one lot. So if I'm receiving the quantity in uniform lots, all right. And when purchase prices do not fluctuate considerably. So when there's a stabilized market, it's more or less the purchase price is the same, then of course we can use the average price. Weighted average, we give the weights to quantities purchased also and the purchase price also. So we'll be understanding it in a better way when we do the question. So this method is useful in case where quality of material purchased under different lot varies. So some material has different quantity, some material has different quality. So that's why weighted price gives weight accordingly. Clear? So let us start the illustration under FIFO. Just understand the question. Let me see if there's any query. Okay, so yes, FIFO is who comes first goes first. LIFO, who comes last goes first. Of course, last in, first out, and first in, first out. Inflated price method. Inflated price method is basically when inflated price method is a part of notional price method. Who has asked this question? Sri Lakshmi, inflated price method is a notional price method. Cost is inflated, because of certain things, costs are inflated, and we have to use that in, let us say, there is some shortage. All right. So we'll make you understand when we'll go do the shortages. Inflated price is, let us say I have purchased 100 units for rupees 1,000. Out of 100 units, 10 units have gone waste, or let us say there is a normal loss. So that means the good units left with me are 90 units. So 90 units have to cover now the 1,000 cost. All right. So that is the concept of inflated price. Earlier 100 units were covering 1,000, but now there is a loss of 10 units. So now 90 units will be covering the 1,000. So price per unit has inflated. That's the inflated price method. When the good units will cover the total cost because there is a normal spoilage or shortage or waste, whatever it may be. So cost per unit will increase. So if I divide 1,000 by 100, the cost per unit is 10. But if I divide 1,000 by 90, the cost per unit will increase. So that is the inflated price. When the good units will bear the burden of the cost, the per unit cost is going to increase. All right. That is inflated price method. So I'm leaving with you the question on FIFO. We'll take a break of 5-10 minutes and we'll come back. So by the time you can just understand FIFO, and we'll start with this illustration after the break. All right. Palak, I will be explaining weighted price method again. Of course, we are doing a question, and with the question, I'll explain you weighted price method properly. Don't worry. All right. All right. So we'll meet after the break of 5-7 minutes, please. All right, students, welcome back. So I left you with the illustration on FIFO. So let's see how it works. So yes, there is an opening stock which must be left from the last month probably. So as I said, mostly store issues are made month wise. All right. And we calculate the stock which is left at the end of every month. So the beginning of the month, if we assume that it is made monthly, so there's an opening stock 1,000 units at 5 each, and then we have made fresh purchases at rupees 6. Then on 7 January, we have issued 1,200 units for production. So this is the store's ledger where we record the opening balance and then all the purchases we have done and then the issues we make to the production and then fresh purchases. So fresh purchases happen continuously and issues also happen continuously. So we follow date wise. We just have to follow a date and accordingly we have to record the purchase or the issues and then the balance. So this is the basically the solution you can understand here. So we make these columns, the main 4 columns. The first is the date, then is the receipt. Receipt means the purchases we must have made. Issues column basically is for the production. So issue means we have issued the material for production and the balance is the material we are left with. So balance will always tell us how much inventory I have in stock, the quantity and also the value. So let us say if I want to know on 7th of January how much stock I have. So I just have to go to the balance column that okay, on 7th January I have 700 quantity and the value of the inventory is 4,200. So at any point of time, I can see that at which date, how much quantity I have and against how much is the value of that inventory we have in hand. All right. So this is the receipt, of course, is the purchases we made. So on 1st January, as you must have noted the question, on 1st January, we had the opening balance. So balance 1,000, the rate was 5 and the value of the inventory was 5,000. On 3rd January, we made a purchase. So receipts will show the purchases. 900 units at 6 per unit and 5,400 was the value of purchase. And then we'll update the balance. So both the balances were the stock we have as on 3rd of January. 1,000 was the original balance and 900 was basically the new purchase. Clear? On 7 January, we have to issue 1,200 units. So in FIFO, the oldest unit will be issued first. Clear? So first 1,000 will be issued and whatever lot we are issuing from, the rate of that particular lot only we are using. So first 1,000 was the oldest stock will be issuing first and the rate will be 5 of that particular lot and the value is 5,000. Clear? And then 200 will be from the next lot of 900. So first in, first out means the oldest stock will be issued first and then the next one will be issued. So out of 900, we need the balance 200 because if I can go to the question, we issued 1,200 units. So 1,200 units means 200 out of this lot at the rate of 6. Clear? So this is the basically value of issue. And then we have to update the balance. So 700 is left. Clear? 1,000 was issued fully and then out of 900, 200 was issued. So 700 was left out of this stock only. Clear? So the rate is only 6. So this is the balance of stock as on 7 January. Then we had fresh purchases on 11th of January. So update the balance. 700 was the oldest one which was left and 800 is the new purchase. So this was the oldest one and this is the new purchase. Then we have an issue on 13th January. We have 1,000 units we have issue. So 1,000 units we have issued for production. How will we take? First, we'll consume 700 units. Clear? So 700 units will be issued first of that particular lot. The rate of that particular lot only will be charged. All right. And then after 700 is consumed, then we'll move to the next lot. So 300 will issue from this lot because we want 1,000 units. So the next 300 will be from this lot. So the rate of this particular lot only will be used. Clear? So out of 800, 300 were used and 500 is left at the rate of 6.2, which was actually left. and the value of closing stock is 3100. So 500 units at the rate of 6.2 is 3100, the value of closing stock. So this is nothing but the closing stock we have calculated under FIFO method. So this value of closing stock actually goes to the trading account when we see closing stock. Clear? So here it is calculated and there it is posted. All right. So I hope no issues in FIFO method. So this is the stock. Yes. So most of the students have calculated also. All right. So just have a look for the last 10 before I move on to LIFO method. Any doubts on the FIFO you can ask. Shall we move to LIFO method? Okay. So the LIFO method is an illustration for LIFO method. You can click a picture of the screen because I have to move for the solution. So you should have the solution or the illustration with you. So just note down the question or click a picture of the question so that when we move to the solution, you will understand so that we don't have to go back to the question again and again. So LIFO method, the latest will be issued first. So in LIFO, we have the opening stock, then we have purchase of 800 units at 21 each. Then we have the issues, then purchase, then 2 issues, then purchase, and then the issues. All right. So shall we start the solution? The same format, make 4 columns, date, receipts, issues, and balance. The latest purchase will be issued first. All right, good. All right, so Sunil is asking how falling prices gives better results in FIFO. See, falling prices means if the prices are falling, and under FIFO, we take the cost of production will be at the highest prices. So it's just in contrast with LIFO. See, if I am issuing the oldest ones first, oldest ones must be at high prices because there is a trend of falling prices. So the oldest stock will be issued first. That means the cost of production will be high. So cost of production will be high, consequently lower profits and lower income taxes. And the closing stock will be at the falling prices. That means the latest purchase will form part of closing stock. And closing stock should always be valued at the lowest. All right. So that goes with the accounting principle also. How we value the closing stock? Market price or cost, whichever is less. So FIFO price in falling prices, FIFO is better because closing stock will be valued at the lowest of the prices. So in the balance sheet, closing stock will be at the lowest and the cost of production will be at the highest price because the oldest stock is issued first. So that means the oldest price must be at higher prices. It will be issued first. So cost of production will be at higher prices. Higher cost of production means lower profits and thereby lower taxes. All right. So I hope, Sunil, you have got the point here. Let us move into, get back to LIFO, and I'm taking you to the solution. So this is the solution of LIFO. Again, the 4 columns, date, receipts, issues, and balance. So if you have taken the note of the question, there was opening balance of 1,000 units at the rate of 20. So 20,000 was the opening balance. So balance is 20,000. We have purchases of 800 on 3rd of March. So update the balance. 1,000 was this original one and 800 is the new purchase. Clear? So 2 stocks we have, one at 20, one at 21. So LIFO means latest one has to be issued first. Latest one means out of 800, it should be issued first. So the first issue has to be 1,200 units. 1,200 units, first we will consume 800. That means the latest purchase will be issued first. Clear? The latest purchase will be exhausted first. So 800 we have consumed first, we have issued first, and the balance 400 will be from the earlier lot. All right. That is LIFO for you. Last in, first out. And then once it is exhausted, then we'll use the earlier one. Clear? So out of 1,000, 400 is issued, and out of 1,000, only 600 is left at the 1,000 of prices. Clear? So this is how LIFO works. The latest purchase will be issued first, and once it is exhausted, then we'll move to the earlier one. So out of 1,400 we have issued of that particular. So the rate will be of that particular lot only. This you have to keep in mind in cost price methods. Clear? So lot wise rate will be charged to production. And the balance 620, 12,000. Then there's a new purchase 1,600. So 600 was the older one and this is the new one. Clear? So on 15th we have the new issue for 1,000. 1,000, that means the latest will be issued first. All right. So the latest purchase is my fresh purchase. Latest means the fresh purchase. We will issue from the fresh purchase now. And then that means out of fresh purchase also 600 is left. And 600, the oldest one is also left. And the latest purchase also 600 is left. So LIFO is the last purchase, means the fresh purchase will be issued first. So we are left with 600, that is the initial stock, and 600, the latest purchase. So out of 1,600, we have issued 1,000. We are left with 1,600. So old stock and the new stock with their respective rates. So that is the balance. Then again from our March 20, we have another issue of 600. So of course, the latest one will be issued first, the latest purchase. So again, the oldest stock is left for 20. All right. The oldest is left for rupees 20 at the rate of 20 per unit. So the latest purchase of 12th March, we have exhausted first. Earlier, we issued 1,000 out of 1,600. Now 600 out of the balance. Clear? So on 25th of March, we have again an issue. So 600, it was earlier stock. And this 1,000 is my new purchase. Clear? So on 30th March, we have new issue of 800 units. 800 has to be used at the fresh purchase. Clear? So we have left with 600, but we will still be issuing out of the fresh purchase of 1,000 because this is last in, first out. The fresh purchase, the latest purchase will be issued first. So out of 1,000, I have issued 800 with its respective rate. And again, we are left with 600, the oldest stock, and 200, the latest one. So under LIFO, the closing stock is this, the breakup of closing stock, 600 units at the rate of 20, 200 units at the rate of 25. So the total stock is 17,000. Closing stock under LIFO is 17,000. It's the value and this is the quantity. 800 is the quantity and 17,000 is the value of closing stock under LIFO. I hope you must have understood. Any doubts? Very good. Very good. Utkarsh, the value should be 17,000. Yes. So Dhyanesh has calculated it well. 600 units at the rate of 20 and 200 units at the rate of 25. Yes. Alok also has calculated the correct way. Dhyanesh, yes, it's 17,000. All right. So this is the answer. Utkarsh, there must be some, the problem with your solution, maybe with your calculation. So just correct it. The answer should be 17,000. So I hope LIFO method is clear to you. Last in, first out. All right. Just have a final look for a while so that I'll move on to the average price methods. Okay, shall we move on? Okay, so this is the method, simple average price method. Simple average price method, we take the average of the rates. All right. So just take a note of the question or click a picture of the question so that we don't have to come back to the question again. Take a note of the question. So in simple average price method, we take the average of the rates of the purchases here. So with every purchase, we'll have a new average rate. So there are 4 purchases, there are 3 purchases, including one opening stock. So we have 4 rates with us. we'll be taking the average of these rates at different point of time. We'll see how we have to take, at what point we have to take, and what all rates will be included for the average rate. What all rates we have to include to calculate the average rates, and how we include it. All right. So I hope you have taken the note of the question. So we have this opening stock, and then we have one purchase, one issue, one purchase, then two issues, one purchase, and then issue. So till 29 September, you are seeing the store ledgers generally we make monthly. Clear? So that we get to know how much is the closing stock every month. Clear? So it gives a very good mechanism for cost control and inventory control at proper intervals, rather than waiting for the whole year to end and then start inventory control. It's always better to have continuous inventory control and material control. So that is only possible when we make the records at small intervals of time. So a month would be a very good medium for inventory control when we have the data accordingly. All right. So any queries? Okay, Utkarsh. So glad that you have noted down your mistake and you have corrected it. Moving to so I hope you have noted down the question. Let us move to the solution of simple average method. If you can say clearly, on 1st September, we have the opening balance 1200 units at the rate of 14, and the value is 16,800. Then on 5th of September, we have the new purchase 600 units at the rate of 15 and 9,000. See, we have not written the rates over here because we have to calculate the rate as an average for, every issue. Clear? So issue, we have to calculate the rates of the items in stock. Now, for 1600 and 25,800, so total inventory is 1600, 1200 plus 600. So every receipt will basically increase the stock. Every issue will decrease the stock. Yeah. So 1600, and the value of the stock is 16,800 plus 9,000 makes 25,800. Now we have to calculate the rate, average of the rate. Clear? So first rate is, now what all stocks are available? We have to calculate the average of the rates of stock which are available. Clear? So two stocks are available, one the opening and one the new purchase. The rates of two stock are 14 plus 15. The lots which are available, we will take the rates of those lots which are available. So before this issue, we have two lots available. We'll take the rate of two lots, 15 and 14. Simple average. I have taken two lots, 1 and 2. So average will be 2. Clear? So 2 is basically the denominator will be number of lots I have taken. How many lots I have taken? 1 lot and 2 lots. There are 2 lots available. So divided by 2. If there are 4 lots available, I would have done divided by 4. Clear? So simple average and the rate of the lots which are available. So 14 plus 15 divided by 2, the first average rate comes out to 14.5. So the issue will be made at the average rate rather than a specific lot rate. In cost price, we had taken the 14 rate or the 15 rate. Here we have taken the average rate. So the issue will be made at the average rate. And then out of the total stock, we'll deduct basically the stock. So for out of 1,000, that means how much stock is now left? 800 is left at the value of this. Clear? So the total stock, out of the total stock, we have left with 800. All right. Now we have new receipt, 1,800. 1,800 is the receipt. So we have basically updated the balance and updated the stock value. All right. So we are left with 800. And then we have added 1,800 to the fresh issue, 2,600. The value is this. We just add the quantity and add the value to the value and add quantity to the quantity. All right. So on 18th of September, we have the issue 1,200 units. So 1,200 units we have to take from, now we have to see which lots are available. Clear? So here we can take the FIFO method. So 1,000 was issued. That means still there is, this lot is also available. Now there are 3 lots, 14, 15 and 16. There are 3 lots now, 14, 15 and 16. So you have to take the average of the 3 lots. Okay. So 3 lots are now available. How you will be calculating? 14 plus 15 plus 16. How many lots we are taking? 3. So average of 3. The average comes out to 15. 14 plus 15 plus 16 divided by 3. We are taking the average of the lots which are available, which are not exhausted. Only 1,000 units were issued. That means no lot is exhausted. The earlier, that means 1,000 must be issued from this lot only. So this lot is also existing. It's not exhausted. Out of 1,200, only 1,000 must have issued. So this is also there, this is also there, and this is also there. So 3 lots are available. We have to take the average of the 3 lots. I'm repeating, we have to take the average of those lots which are still there, which are not exhausted or consumed completely. Clear? So this is the rate we have taken. The balance out of this is 1,400. So out of 2,600, we have issued 1,200. And then 14 are left. So reduce the quantity from the quantity and amount from the amount. Clear? Then we have another issue, 400. So now see if you can see 2,200 lots are issued. 2,200 units are issued. That means this lots must be exhausted now. All right. 2,200 units have already been issued. So that means 1,200 and this also has been exhausted. 2,200 units have been issued. That means only this lot is available. Only in 13th September lot is available. Both the lots must be exhausted by now because we have already issued 2,200 units by now. So 1,200 plus 600, 1,800. And from this lot also we have issued, but this lot is still available. So only one lot is available. So we have applied for only 16 rate since only one lot is available now. All right. So we will be issuing 400 units at the rate of 16 and the balance, reduce the quantity from quantity, reduce the amount from the amount. So 1,400 minus 400, 22,100 minus 6,400. So this is the balance left. All right. Now again, we have the new lot on 26th of September. So the new lot, add the quantity to the quantity. So 1,000 was balanced plus 800. So 1,800 we have left with. Add the amount to the amount. Every receipt will increase the balance. Every issue will decrease the balance. Add the amount to the amount, 15,700 plus 14,400. So this is the balance of stock. Now I have to issue again on 29th of September, 1,000 units. Now which lots are available? This lot is available and this lot is available. So take the average of these two lots. How to take the average? 16 plus 18 divided by 2. I'm taking two lots, 1 and 2. So 17 is the simple average rate. So you have to take the average of those lots which are available. The lots which are exhausted, with the rate of those lots we will not include. All right. So this is the main thing you have to understand in calculating the simple average rate. All right. So the closing stock as per simple average is 800 and 13,100. Is 800 and 13,100. Any doubt? I just see the queries. Is there any discrepancy? Okay, is there any discrepancy? Yes, yes. Yes, it should be 1,800. Yes, it should be 1,800. So thanks for correcting here. And accordingly, I think you can correct the question. See, exhausted, Utkarsh, you have, who has Harshu? Harshu, we will see as per FIFO method. Simple average can be clubbed with FIFO method. So the lots which will be issued first, which we have purchased first, will be issued first. So the lots which are in stock will be issued first, and the balance of the stock, the rates we will be taking. All right. So I think that there should be some correction. So please give the corrected stock. There is some discrepancy, I think. In the balance, so 1200 was the balance, and new purchase 600, it has to be 1800. So accordingly, I think you can change the question. But yes, the average rate should not have any problem, I guess. So can I have the updated closing stock? Yes, Pranav. In simple average method, we have to go with FIFO along with it, because otherwise, how would we know that which stock is exhausted and which lot is still there? So you can club it with FIFO method in the simple average. All right. Okay, so you should make working notes actually, because for computing of the average rate. So your working note should form part of your answer. All right. You cannot do working note in rough. You can always show the working note for calculation of averages. Clear? All right. So, okay. So again, there was a discrepancy of 200 units. So the unit should be 1000 units. So who has corrected? Yes, Dinesh has corrected. All right. The average should have been 1440 is there. All right. So 1000 units should have been the balance. So I hope you got the concept right. And we can club it with FIFO method so that we can know that which lots are exhausted and which lots are available. All right. Okay. All right. I got it. Pranev, thank you. Yes, he's saying that amount is wrong, but the closing stock is correct. All right. Good. Okay, so that is all for simple average method. I hope you got the concept right. And yes, we can club it with FIFO method to see which lots are available and which are exhausted. Moving to the weighted average method. So quickly take a note of the weighting average method illustration. Click a picture or take a note of weighted average. Student, please redo the question again so that I think you have different answers for closing stock. So do the question again for this simple average and then find out the stock. All right. For the time being, let us start the weighted average method. Hope you have taken the question, the note of the question. All right. So moving to the weighted average method now. So there is an opening balance of 1000 units at the rate of 20. So 20,000 is the opening balance. Then the new purchase 1800. And now how to calculate the rate? In weighted average method, we actually divide the amount with the quantity. All right. So the rate has no value, but the amount and the quantity has its own significance. So the total amount and the total quantity. So the total amount has to be 36,800. So add amount, rate, quantity to quantity and amount to amount. So 1000 plus 800, 1800, 20,000 plus 16,800, 36,800. So 36,800 and 1,800. If you divide it, so weighted average means, see, in simple average, we have done the rates, average of the rates, rate per unit. But in weighted average, we do the weighted average rate, amount divided by quantity, total amount divided by total quantity. So always remember, in weighted average, with every new purchase, a new weighted average rate will be calculated. I'm repeating, there are two main properties of weighted average method. The first rule is, with every new purchase, a new weighted average rate will be calculated. The second rule is that till the time the new purchase is made, the same weighted average rate will be applicable. So weighted average, a new weighted average rate will only be calculated at the time of new purchase only. Till the time of next new purchase, the same weighted average rate will be used for all the issues. I'm repeating. the weighted average rate will be calculated only at the time of new purchase. Till then, the same weighted average rate which you have calculated till the time of last purchase will be used for every issue till the new purchase. Clear? So that is the main part of it. Let us calculate the rate here. 36,800 divided by 1800. The rate is 20.44. 36,800 divided by 1800. You get the weighted average rate of 20.44. The individual rates do not matter in weighted average. Clear? So every issue. So till the new purchase, all the issues will be done at 20.44. So 1200 units are issued. So it will be issued at 20.44. You just have to reduce the balance from the balance. So 1800 minus 1200, reduce the amount from the amount. 36,800 minus 24,528, you get a new balance. Then you have again a new purchase. At the time of new purchase, again a new weighted average will be calculated. All right. So 600 was the balance plus 1600. Add quantity to quantity. 2200 is the new quantity with new balance. Add the amount from the amount. So 12,272 plus 38,400. Add amount to amount, add quantity to quantity. So every receipt will increase the quantity and the amount. Clear? So the new amount will be 2,200 and 5672. Weighted average rate, a new weighted average rate will be calculated only with the new purchase. Before that, no new weighted average rate will be calculated. So 50672 divided by 2,200. 50672 divided by 2,200. I'm calculating so that no discrepancy comes. In the last question, there was one discrepancy. So yes, this is the new weighted average rate. So this rate will be applicable to every issue till the new purchase. Clear? So see, we have not calculated any new rate for 20th March issue. We have used the same weighted average rate. New weighted average rate will be calculated only at the time of new issue. Till the time the same weighted average rate will be continued. All right. So we have done the 1000 issue at this rate. So let's reduce the amount from the amount and the quantity from quantity. 2,200 minus 1000. This is the balance. 50672 minus 23030. This is the balance. Then again, there is an issue. 1200 minus 600, 600. 27642 minus 13818. So this is the new balance. The rate is not going to change. Clear? Then again, the new issue on 25th of March. The new issue on 25th of March. So add the balance to the balance and quantity to the quantity. And now a new rate. 38824. Remember, the rate will be calculated only at the time of new purchase. 38824 divided by 1600. 2426 is the new weighted average rate. So see, there are 3 purchases and we have calculated weighted average on 3 times only. Clear? So we will calculate the weighted average rate only at the time of new purchase, not before that. Clear? So then 800 will be issued at the new weighted average rate. Reduce the balance from the balance, reduce the amount from the amount. So this is the closing stock as per weighted average. I hope you must have understood. Any queries? See, weighted average method basically is used when you are purchasing quantities in different lots, all right, and different quality of material is received. Simple average method can be used only when you are purchasing the quantities in similar quantity. 100, in one lot I'm purchasing 100, then in another lot I'm purchasing 110, 120, then 90. So uniform quantities you are purchasing and of a similar quality, then you can use simple average. Simple average can be used only when there is a stable purchase. in quantity and quality both. But weighted average should be used when there is huge difference between the quantity. In one lot, you're purchasing 100, in another lot, you're purchasing 200, in another lot, you're purchasing 250. So when there is variation in quantity and also quality of raw material, then weighted average rate should be used. Clear? So when there is no uniformity in your purchases regarding quantity and quality, then simple average. Weighted average rate is used only when there is huge differences and variations in the quantity purchase or the quality purchase. Clear? Then weighted average method is most suitable because it dilutes the difference between the rates. All right. So I hope, okay, good. See, some fraction should not, some fraction should be there. So that is okay. Okay. All right, fine. So I'm glad some of you are able to do it. I think, Utkarsh, you please try the simple average method again. It's very simple to use. The weighted average is still difficult. I hope you have understood the weighted average. You again try the simple average method, and I'm sure you will be able to solve it. All right. So that is again one practice question. You can just take note of, and you can practice on your own. So this is an illustration. You can take this illustration. Now here, let me just explain you quickly how basically this goes. So see, opening balance, then there is an issue. I just explain you the question. You practice on your own. I'll provide you the solution also. All right. So receipts, that means the purchase, goods received note. And this at this place, so this is the basically the purchase. GRN is goods received note. We issue the GRN when we make the purchases. Then we have the issued. So this the FIFO method we have to use here, right? Return to B and company. Return, that means we have made the purchase returns. So this is the purchase returns. So purchase returns basically will be valued at the same price. See, sometimes we should do the purchase returns at the issue method price, the price of the method of issue we are following. Like in this question, we are following the FIFO method, but normally we return it at the invoice price only. So again, if we are returning it, it will be shown in the it will be shown in the base. We are returning it back, so it will be shown in the issue column at the same price only. We are returning it back. That means the stock should decrease. My balance should decrease. All right. Then we have issues. Then again, we have receipts from NN company, goods received note at this price. So this is a new issue, or this is a new purchase. So one purchase and two purchase and one purchase return. So purchase return will be at 5.75 only. And it will come in the issue column. So this is the receipt and I'm returning it back to BN company. So it's purchase return. So 10 units will come at the issue column at 5.75 only at the price which I have received, at the invoice price only. I'm not, we should record it at the issue price depending upon the method we follow, but we basically charge it at the invoice price only. And then it's a new receipt, then issues and the FIFO method. Received replacement from BN company. See, we returned the 10 units back to BN company, and BN company has issued the replacement. So we have received the replacement of 10 units. It will again come at the receipt column and at the same price, 5.75. Clear? So these 2-3 things you have to take note of. Rest, I think you can do as per FIFO method. So what I'm explaining you, what are the different adjustments here. So purchase returns will be done at the invoice value only. And we have received replacement from BN company. It will come at the receipt column only at the original price only. All right. Return from department material of B company. That means we have issued to production and that department has returned back. Must be the material must be surplus with them. So they are returning it back to the stores. All right. So this is different. On 20th of September, the department to which we have issued the material, they have returned the material back to the stores. Maybe because it must be surplus to them. So 5 units, they have returned it back and the material of BN company. So that means it must be issued at 5.75 only. So 5.75 will come at the receipt column again. We have received from the department. So it's basically returned internally. It's an internal return back to the stores. So stores will issue it at the receipt column only. It will be shown at receipt column only. And B and Company material is returned. So B and Company material must be issued at 5.75 only. So that way we have to record it at 5.75 only. Transfer from one job to another has nothing to do with stores issue. So material is transferred or shifted from one job to another. There will be no entry in the stores because stores has nothing to do with it. Stores have issued the material to any department. Within the department, if you are shifting the material from one job to another job, stores has nothing to do with it. All right. So this is a stores ledger. This is not a department ledger. So stores has nothing to do with it. No entry for 22nd of September. Then we have issue again. Transfer from department A to department B. Again, it has nothing to do with the stores ledger. So I have issued to department A. Now department A is issuing to department B. It's transferring its material to department B. Maybe it's surplus or maybe due to a production process. Stores has nothing to do with it. All right. So internal shifting, internal transfer from one job to another or from one department to another has nothing to do with the stores ledger. All right. Shortage in stock. See, shortage in stock has to be dealt with the same way as issue. So treat it as a issue only. So shortage in stock means it will be issue only and it will be priced at the method of issue. So it will just follow, you just follow it as it's another issue at the FIFO method. Clear? So any shortage will be taken care of as we take care of any issue. Clear? So it will be treated as an issue only and as against whatever method you are following, you just charge it at that rate. All right. So that is the difference in this illustration that I have explained you. I'm just moving on to the solution. So just take note of the solution quickly. Okay, Vora, I'm glad that you have understood. Okay, so see, this was a solution which I was explaining you. So this was the balance. This was the issue. FIFO method we are following, right? So this was the new purchase. So this was the quantity that was left. Then it was issued. So this is left again. Return back to the seller. All right. We have purchased it and we are returning back to the seller. So at the same price, we will return it. So returns will come under the issue column at the same invoice price. Clear? So now this is a return. So we'll include it in the issue column only. That's exactly what I was trying to explain you. And yes, the balance of the issues and then the new purchase. Clear? So there are the normal issues. So normal issues are happening under FIFO method. Then again, new purchase and again, another issue. You please click the picture. We'll be sharing the PPT also with you. So moving on, the solution is continued. See, we have received the replacement of 10 units. So at the same rate, we'll be receiving the replacement. This is the replacement from B and Company, the material which we have returned. We have got the replacement of the better material from the same company. So we have to, record it at the same invoice price. Clear? And then it's a departmental return, basically returned from the department back to the stores. So B and Company material was returned from the department to the store. So since it was the material which was of B and Company, so the rate of B and Company only will be recorded here. And this material should be shown first because the material which are returned from the department should be issued now first. All right. So since it's a FIFO method, we have kept it at the first lot so that it gets issued first. Clear? Now the shortage will be taken care of as it was the issue. And since it's FIFO method, the shortage will be taken from this rate only. So see, 20 minus 2, 18 is left. So shortage will be considered and treated just like issue at the rate which as per the method of issue you are following. All right. So there are 4-5 adjustments which you need to understand here, which I have explained you. So just quickly, purchase returns will be at the invoice price. Then replacement again at the same invoice price. Return from the department in the receipt column at the same price, because it's a FIFO method, and BN company material must be issued at 5.75 only. Internal transfer from one job to another has no role in stores ledger. Internal transfer from one department to another has no role in stores ledger. All right. So that is how it goes. Last look at the solution. So this is the stock left as per FIFO. Pranav, it's mentioned in the question that we have to follow FIFO method. Pranav, it's mentioned the last line. It should be, we follow FIFO method. All right. So it's mentioned in the question. We have not assumed it. It's mentioned in the question. All right. Okay. So students, we are moving to the last segment of the session, normal and abnormal losses of materials. So basically, some normal losses and wastages has to happen, and some abnormal, which we need to control and we have to minimize. All right. So whatever method we adopt, certain differences between book value and the physical stock. So book value shows the units, 100 units, but when we do physical stock taking, then, the physical stock is generally less than the book value, because there has to be some normal wastage, normal loss, which the book value cannot predict or measure. But when we do the physical stock taking, physical measure, then the basically discrepancy comes. So this may be a gain or a loss, should be transferred to inventory adjustment account pending investigation. So when we will doing cost accounting system, the books of cost accounting, then you will understand in a better way. But yes, you should know how we do deal with the adjustments. So if upon investigation they are regarded as normal, they should be transferred to overhead control account. If abnormal, they have to be transferred to costing profit or loss account. So always remember, normal loss could be shortage or waste or scrap, whatever. If it's normal, it should be absorbed by good units. If it's abnormal, it should not affect the cost of production. It should go directly. It should charge to the profit or loss account. All right. So this is a normal fundamental. Any normal loss means it has to happen. You cannot avoid it. So normal loss will be taken care and absorbed by the good units. That means the left units, whatever are the leftover units. Abnormal loss, which should be avoidable, should not affect the cost of production, and it should be taken and charged as an abnormal loss to the profit or loss account. Clear? So waste is basically comes in the waste generally arises due to raw material in processing or storage. So waste generally arises initial part of production, or let us say while storing the raw material, only the waste arises. So waste generally happens initial process of production, or just we are storing the raw material and there is a waste. Clear? So waste could be visible and invisible. Invisible means evaporation. Waste is evaporation. So raw material, some kind of evaporation like chemicals or some type of raw material which evaporates. All right, or in gases form. And some are visible like the dust, the sawdust, let us say salt, there's a rock salt. And if we are breaking the rock salt into small pieces, that dust has to happen. You cannot control it. All right. So waste happens while offloading and uploading, there is a waste of material, or it evaporates, or when you are breaking the bulk into small pieces, then there has to be some waste. So you cannot avoid waste to much extent. So normal waste has to happen. You cannot avoid it. Clear? So basically, raw material, dust, invisible is disappearance of basic material through evaporation, smoke, or the material gets shrink. Shrink means it contracts. So the material, the weight was 10 kg and then it got shrink. So the weight came out to 9.5 kg. So there has to be a waste of raw material. It's inherent. It's inbuilt in the nature of raw material. So normal wastage is to be absorbed by basically the good units, and abnormal as always to be transferred to profit or loss account. So we'll understand with the help of example. For let us say example, the total units we received was 2000, amount was 13,300. So normal waste has to happen. So 100 units has to happen. So whenever I will purchase 2000 units, 100 units will go off as waste. It will happen always. Normal waste means it's unavoidable. Due to the nature of the raw material, it will happen always. Clear? So you can't avoid it. So the good units are 1900 and they will bear the cost of 13,300. See, if 2000 units will be at 13,300, the cost of unit will be a particular cost of unit. And when 1900 units will be a 13,300, of course, the cost of the cost per unit will increase. Clear? So that is why it's in some student as inflated price. So that is the concept of inflated price. The good units will bear the total cost now. Earlier 2000 units should bear the total cost, but now 1900 will bear the total cost. So the cost per unit will increase. Clear? So this is the cost per unit. So this is the normal output. With every 2000, we have to have a waste of 100 units. That is a normal waste. Assume it's always estimate. It's an estimate due to past experiences. Okay, by out of 2000, 100 units has to go on waste. So this is a normal waste. Abnormal means, see, 1900 should be the normal units. But let us say there is again an abnormal waste of 50. Let us say due to carelessness of the storekeeper or the mishandling of the raw material, this 50 units of loss can be avoided, but it could not be avoided. So this 50 units, ultimately my actual output is 1850. All right. So, but this 50 units could be avoided. 100 cannot be avoided, but this 50 could be avoided. So see, we have not taken the value of the normal loss, but we always compute the value of abnormal loss. This will go to P&L account. All right. So how you will be calculating? If the cost of 1900 units is 13,300, how much is the cost of 50? So this way we have calculated 350. 13,300 divided by 1900 into 50. So this is the value of abnormal loss. It will go to profit or loss account. All right. And this is the cost of normal output. And this is the actual output. So the normal rate per unit will be 13,300 divided by 1900. So this is how we take care of normal and abnormal. Okay. This will not be included in the total cost of production. It will go to P&L account. Then is a scrap. This scrap is the incidental residue from certain types of manufacture. So scrap occurs only during manufacture process. If you can see, if you have seen the wood cutter, all right. So the carpenter, when the carpenter shaves the the wood, so there are shavings or sawdust. All right, sawdust of the wood. So when he shaves the log wood. All right. So some shavings of the wood comes out. So those shavings, those are scrap. So scrap is generally have some value, and scrap occurs only during the process of manufacture. Initial processes of manufacture only scrap occurs. So scrap may be treated if it's negligible. So it's excluded from the cost. All right. When the scrap is not identifiable to a particular process, we are not able to identify out of which process or out of which job the scrap is being, occurring. It's all in one lot, is gathered at one lot. Then the scrap value. See, when we sell the scrap, we get some income also out of it. Scrap sale. We get some income out of it. So the scrap value, the sale value of the scrap net of selling and distribution cost is deducted from the overhead. So whatever we realize out of scrap, basically we deduct. All right. So let us say we have the cost is 10,000 and we have sold the scrap for let us say 500 rupees. So we can deduct 500 from 10,000. So my net cost is 9,500 now because I've recovered 500 out of that scrap sale. So scrap generally is of small value, and we can ignore it and we charge it as other income in the profit or loss account, or we can deduct it from the total cost of production also. So when scrap is identified with a particular job, the scrap account should be charged with full cost. All right. So how now spoilage? We'll do a certain question so you will understand. Spoilage happens during the later stages of manufacture. All right. Spoilage is, that means goods are manufactured which are substandard quality. Goods which the final product, the finished goods which do not match the quality standards. And those goods are so spoiled, so damaged that we cannot even rectify it. And they have to be sold as, seconds, or they just have to sell it outrightly. So spoilage is that goods are damaged, the finished goods. The finished goods in the later stages, when there is a time that the finished output will be come out. So the finished output is so damaged, it's so substandard that even we cannot make it better by additional cost. All right, it is so damaged. So it is a term used for materials which are badly damaged in manufacturing operations. They cannot be rectified economically. Huge cost will be incurred again. So there is no point of, rectifying it. Again, a lot of cost has to be incurred on them too. And again, they will be substandard only. So spoilage happens only, due to, let us say, faulty tooling or poor workmanship or substandard materials you have used. So the defective goods will come out. Defective, which cannot be rectified, and hence taken out of the process to be disposed of. So basically they are disposed of as it is because they cannot be rectified also. So much damage goods or substandard goods we have got from manufacture. Normal spoilage again. So normal spoilage always will be, charged by the good units. And abnormal we always take to profit or loss account. So basic fundamental is the same. Normal spoilage that has to happen, we have to take it into consideration. But abnormal, it should not affect the cost of production. Defectives. See, defectives are those spoilage which can be rectified and they can be sold as seconds. So difference between spoilage and defective is spoilage are totally damaged. They cannot be rectified. Defectives are those spoilage which can be rectified and which can be made better by additional material or labor expense. All right. So they can be made as a good product if additional labor or material can be incurred on them. So units or portions of production which can be rectified and turned out as good units by application of additional material, labor or services. So spoilage cannot be rectified, and defectives, they are substandard, but they can make it still good. Not the best as per the best standard, but again, in a better way, they can make it better. Defectives are considered inherent in the process and are identified as normal. So if they are normal, again, we have to absorb it in the cost of production. Charge to good products, the loss is absorbed by good units. So every normal loss, whether it's defective or scrap or spoilage or waste, has to be absorbed by good units. Charge to general overheads, when defective caused in one department are reflected only on further processing. The rework costs are charged to general overhead. So basically, one department are reflected only on further processing. Basically, the product has gone to the other department or the process, and then only we have identified. So see, that means it does not belong to any department as such now. So we charge it as general overheads. When the department responsible for defectives are identified that, okay, this is the department where defectives have arisen, then the overheads, the additional cost will be charged to that particular department only. And when you cannot identify any particular department, then it will be charged to general overheads. All right. But when you identify that this defective has arisen in this particular department, then that particular department has to bear the additional cost also. Yeah. Charging to profit or loss account if defectives are abnormal. Again, poor workmanship or bad supervision or, bad inspection. Nobody actually supervised it properly. So it's abnormal. It could be avoided. So of course, any abnormal loss or shortage or scrap or spoilage or waste has to be charged to profit or loss account. So when defective are identified with specific jobs, they are debited to that job. So defectives always, the defective goods are always made good by additional material, labor and expenses. That you have to understand. So waste is basically at the initial stage or at the raw material storage stage. Scrap happens normally at the initial stages of production, and scrap can be sold. All right. Spoilage are defectives which are totally damaged and which cannot be rectified even after additional material labor cost, and they happen in the later stages of production. Defectives also happen in the later stages of production. The finished output, which is substandard, but which can be made equivalent to good, not good, but equivalent to good with additional material labor and overheads. All right. Okay, so there is one illustration here. You can quickly take the note of this illustration. Okay. Normal loss, the amount of loss increases. Yes, exactly. So normal loss, then amount of loss increases the cost per unit. Yes, normal loss always increases the cost per unit because the good units will bear the total cost now. And the good units will always be less than the total units. All right. So normal loss always increases the cost per unit. And abnormal loss will be transferred to profit or loss account. Yes, Utkarsh, the slides will be available to you. Scrap is not exactly a byproduct because byproduct has its own costing. Byproduct has a significant value, but scrap does not always have a significant value. All right. So scrap is not a byproduct. Scrap is more of a residue which have significant or no value, no market value as such. But byproduct can be used as a raw material for other things like molasses. In the production of sugar, molasses happen. Molasses is a syrup which is extracted from sugar production, from sugar cane. So molasses can be used as a raw material in the making of alcohol. But scrap cannot be used, as a raw material as such for other products. So scrap and byproducts are two different things. Byproduct is still a better product. All right. It can be used it can be sold at a better market price. But scrap actually is a scrap, is a residue. All right. No, spoilage and waste are not same. Waste can happen only at the initial stages of the raw material or the production process, right? Like breaking of rock salt into pieces. That is waste. That is not spoilage. Spoilage happens only after the later, spoilage is like a finished output, a defective finished output. So waste is at the initial stages of production and spoilage happens at the later stages of production when there is a time for the finished product to happen. All right. So let us move to this question. Quickly take note of that question so that we move to the solution. Hope you have taken no, it is not a capital receipt. Scrap value is not a capital receipt. We deduct the scrap from the cost of material. So let us say if the cost of material is 10,000 and we have recovered this 500 from scrap. So we'll deduct the scrap value from the cost of material. It's not a capital receipt. Capital receipt is something which has to carry forward. Scrap, what you will do to carry forward the scrap? Scrap is not a capital receipt. All right. So scrap, you can say, is a temporary gain. It can be seen as a gain. All right. Moving on to the solution. So see, we have the quantity of 2000 as input and the value is 8000. So just try to understand the question. See, 2000 kgs of art board valued at 8000 issued. So this is the raw material. 2000 kgs is the raw material. The board, it's the board valued at 8000. So we have to calculate the cost of medium size carton. Medium size carton means cost divided by units of medium size carton, right? So 2400 medium size good cartons. All right. Good cartons means excluding the defective ones. Good cartons weighing 0.5 kg each were manufactured. That means one medium size good carton takes half a kg of board. All right. So one medium carton takes half a kg of the board. So now 480 offcuts. Offcuts means now these offcuts are basically the spoilage. Offcuts of the, you can see it as a scrap also. The leather business or let us say the leather or the cloth. So they cut the corners, all right? So offcuts basically are you can say the scrap, which can be used for making other things also if they are used in that. So offcuts for the medium size carton, we cut the carton for a medium size. And out of the offcuts, we have manufactured small size cartons also. So the corners left from the medium size were made were used to make the small size cottons. All right. And this would have amounted to 1,000. So basically, out of the same cost, we have recovered small size cartons also. Clear? So out of medium size cottons, raw material, we have recovered the small size cartons also. And 320 medium size cartons were damaged and rectified. That means they are defective. If they are damaged and not rectified, then they are spoilage. If they are damaged and can be rectified, then they are defectives. Clear? So medium-sized cartons were damaged and rectification cost came out to 160. 120 kg of offcuts was sold as scrap. So this is 20 for rupees 20 they are sold. Clear? So the question is clear. 2,400 medium-sized carton, good cartons, not defectives, are made. 480 offcuts from the same kgs. 480 kgs were used to make small-sized cartons and the cost would have been 1,000. But now they are made for free. 320 medium-sized cartons were defectives. That means this is additional cost of rectification. And 120 offcuts were sold as scrap. So these offcuts were not used for any purpose and these offcuts were used for small-sized cartons. So let us just move on now to the solution. 2,000 units we started with, 2,000 kgs of raw material. We have to calculate the cost of medium size. So we have reduced the units or kgs used for small size cartons. Offcuts transferred to small size cartons. So that means these are effectively used for medium size cartons, right? Less value of scrap sold. So scrap sold is always a deduction. Add cost of rectification. See, we are not adding here the defectives units, because this includes the cost of defectives also. So we are not adding the 2,000, it's including the defective units also. So we are not, excluding or including the defective units. So 2,000 kgs of board was started with. 480, virtually 480 offcuts kgs of board were used for small size cartons. So these were left for the medium size cartons. Then the value of scrap, 120 kgs of the board was basically sold as scrap. So we are left with 1,400. 1,400 means how many now good medium-sized cartons we have made? 2,400 were good plus 320. The defectives were made good. So total good cartons were 2,720. If you can remember, 2,400 good cartons. That means they don't include the defective ones. So this plus 320, the defective. So total, so 2,400 were originally good and 320 were made good by additional costing. So total 2,720 cartons have to be the good medium size cartons. Good. So here it is, 1,400 kgs should be used for making the good medium size cartons. That means 2,800 units should be there, but they have been made 2,720. That means 40 must be a normal waste in the process. All right. So 2,720. So if you just 2,720. All right. So this is the medium size cartons and 1,360. So 40 has to be the waste. All right. So this is how it goes. 1,400 means 2,800 medium size cartons should be used, but we have used only 2,720. So 80 are left. 80 means divided by 2. So 40 must be a waste. So this is the units and this is the cost. So cost per medium size carton is 7,140 divided by 1,360. So 2 point something it will come out to be. So this is the cost per medium size carton we have calculated. All right. So this is how it goes. So here in this question, you can have the treatment of scrap also. We deduct the scrap. See, we have deducted the scrap from the value. All right. So scrap, the whatever value we get from the scrap, we just deduct it from the cost. And cost of rectification, we always add. This was the additional cost over and above 8,000. All right. And because the units are already included, so we have not added here. So this is the total cost for 2,720 units. Okay. And this is how it goes. Just look for a while here. Okay. We'll be sharing the PPT with you again so that if you want to practice it again. Moving on to obsolescence, the last concept for the session. So obsolescence is basically the loss in the intrinsic value of the asset, the basic nature of the asset. So where it is a obsolescence means now that raw material or that part is no more in use. It has gone obsolete. Obsolete, you can say outdated. Let us say I'm using a part in some machine and that machine is no longer in use. So that part has become obsolete. I'm using a raw material in some product. That product has gone obsolete, so that raw material has gone obsolete now. So obsolete means now it's outdated, now we are not using it. So again, it's a loss, all right? Where it is a spare part or a component of a machine used in the manufacture and the machinery becomes obsolete. So if the machinery has become obsolete, of course, that spare part will also become obsolete. If it is used in the manufacture of a product, that product has become obsolete. So of course, the part which I'm using it in the product, that also is useless now. When the material itself is replaced by another material. So I have some material and now that material I'm no longer using because a better material has come. So the material which I already have has become obsolete. All right. So in all these three cases, the value of obsolete material held in stock is a total loss. An immediate step should be taken to dispose it off at the best available price. The loss arising out of obsolete material on abnormal loss does not form the cost of manufacture. So the fundamental rule is that every basically normal loss will be disposed of and the good units will bear it, and the abnormal loss, whether it's spoilage or defective or scrap or waste, will be taken to profit or loss account. All right. So this will close the session with all the concepts we have cleared, with all the material procurement concepts, then with all the material issues, and then of course the losses, the normal losses and the abnormal losses, and a lot of practice questions you need to do. And this PPT of course will be shared with you so that you can practice it also later. All right. So any queries before I close? All right. Okay, so good enough. I hope you have understood the concepts which I tried to explain you. Any issues and any queries you can always post. So thank you, students. Have a great learning. And cost and management accounting is really very technical and you have to do a lot of practice in the concepts and also the practical problems. All right. So over to a good learning. See you soon.